Hi, today we're going to talk about demand and supply of money. So there are three major reasons for money demand. First is for transaction purposes, which is kind self-explanatory. Precautionary demand for like insurance purpose. Uh, for those cases, we buy insurance. We are not sure about future or there are uncertainties. In those cases, money is needed. Speculative demand, it's a kind of when we invest in speculative activities, there's a demand for money. It is inversely related to the money market returns. So if bonds returns are good, so people may just invest in bonds where the returns are definite and very low risky. So that's the way it's kind of inversely related with the money uh, market returns, and it is positively related to risk. So in risky assets like options or some other speculative activities, in those cases you may think it's positively related to risk, because higher the risk will be, the more return it will fetch. So it's kind of understood. And the supply of money is determined by central bank and is independent of interest rate. So that's the reason in this below picture we can see the supply curve is inelastic at these interest rate range. So short-term interest rate, we can see in this picture, is determined by money demand and money supply. So where we have this equilibrium is the interest rate I. So interest rate above and below that, we can see there either we have excess supply. There's excess supply when household and firms want to hold more real money than they desire to invest. And the low interest rate, we can see there are less supply and more demand, because at low interest rate is easier to finance their projects and it's cheaper to get loan and start new activities. So that's the reason there is a higher money demand than actual supply. So central bank can move these interest rates to from high and low by controlling the money supply, by decreasing the money supply, interest rate will go up. By expanding the money supply, interest rate will go down. So central bank can actually move market to the equilibrium. Here we're talking about the Fisher effect. The Fisher effect says the nominal interest rates is equal to the real interest rate plus expected inflation rate. So the real interest rates are relatively stable, and the change in nominal interest rate can be explained by the expected inflation. But it's always not, it's not necessary the actual inflation would be equal to the expected inflation. So in those cases, investors, they demand a risk premium. So we can add a risk premium to this equation. So we can say the nominal interest rate is equal to the real interest rate plus expected inflation plus any risk premium. Central bank in any economy plays a very central role in money supply. It's a banker. Central bank loans money to other banks. It regulates and supervises payment system, and it holds foreign currency reserves and as a conductor of a money policy. So these are the major key roles of a central bank. Some countries, they peg their currency level or their interest rate level to to the major economy or a major currency. So you can see developing market economies, they peg their currency to dollar value. So they want to have their monetary policy and inflation rate, uh, rate of the country to which they peg. So they want their these monetary policy to be the same as the country to which they are pegging their exchange rate. That's the idea. So whenever there is an unexpected inflation, it's not good, because they are higher borrowing costs. The borrowing cost increases because the inflation is higher, and information about supply and demand, because of change in the interest rate, it's difficult to find what should be the correct interest rate. So the money of supply and demand actually interrupts. So information available in the market about money supply and money demand is not very reliable. So these are few costs of unexpected inflation. Thank you.